Hey everyone, thank you so much for joining us for our Winnipeg real estate panel discussion. We're here with Chad Wilson from Ideal Mortgage Solutions, and he's going to answer some mortgage questions for us today. Nav, do you want to get us started with the first question for Chad?
Yes, definitely. So Chad, I know a lot of people are aware that they have to put 5% down if they're buying their first home. Can you talk a little bit about requirements to have cash down for 3 months in the account? And we all know that cash is, one of the most prominent down payment that a lot of people put in. But there are also other kinds. You can do line of credits, gift letters. If you can just maybe talk a bit about what options do people who are buying their first home have other than just putting cash down?
Sure. Yeah, sure enough. The gift is a popular one. Gifted down payments in Canada are approaching $10 billion, I believe, for this year from immediate families. So you're starting to see a real transition of wealth from the baby boomers down into their children to help facilitate the purchase of their homes. So gifts from immediate family are completely fine. We facilitate that with a gift letter signed by the individual gifting the money and the receiver of that gift. And we have to show that the money's been deposited into their name before possession. Borrowing the money for down payment. So I should first say that we've got the closing costs, particularly here in Manitoba, our closing costs, I generally tell people bank on spending about 2% of the purchase price. You can't use borrowed money for that. So you've got to have at least that amount, but there are programs out there that will allow you to borrow the money from an unsecured line of credit. Now, we need to consider that there's money being borrowed and new debt being attached to the application. So they need to be able to facilitate that, the servicing of that debt. So as long as they can qualify to hold the payment on the debt that they're using to fund their down payment, we can use programs with the insurers that will allow them home ownership at the cost of closing costs. There are some additional costs. I could go down a bit of a hole on that. Like not all lenders offer it. There's different levels of cashback type mortgages or borrowed lines of credit or borrowed sources for down payment. Canada Mortgage and Housing increases their CMHC premium to use those programs, but definitely there are options.
Chad, actually, just a follow-up question. I know a lot of my clients ask me that. Is it possible for buyers to pay a higher price to sellers and take that additional increase in purchase price as a cashback to pay for their down payment?
No, 100% no. What in the eyes of the insurer, to put some context to that now, because we've seen that many times. Builders try to get creative with it through sort of price point stuff that will apply down payments through an increased price. But at the end of the day, the price in which a realtor or our client is willing to pay for a home really does set the market price of that home. But in this case, when you've got an increased purchase price and the data being entered as a sale price higher than the actual market value just to support somebody's down payment, it's really not accurate information. So it skews the numbers in real estate.
And good to know. Yeah, thank you.
Just as a follow-up to that too, Chad, you mentioned, through the insurers, but if somebody was not going through CMHC, but they wanted to borrow their down payment, is there any kind of way to do that? Or you basically kind of have to go through CMHC in order to utilize that avenue?
Yeah, so the same rules would generally apply. And I think to put some context around that, Dana, even if somebody's got 20% down, the mortgage is generally CMHC insured. They're just not paying a premium. So the same rules apply. It is very expensive for banks to lend out conventional money, meaning 20% down, there's no CMHC insurance on it. They have to keep that on their books and manage it, and it prevents them from growing and lending out new money. So the way that our mortgage industry works in Canada is they'll sell that investment off into a bond market or some other securitization market on the back end. It gets far more complicated. But to be able to do that, they buy portfolio insurance on it. So although the client's not paying a CMHC premium, there in fact is CMHC insurance 90% of the time on that loan.
Yeah, that answers my question for sure. John, do you want to help us out with the next question?
Yeah, just before we move on, I want to touch on the gift letter. Chad, when that's coming from your parent, your relative, do they also verify that it's been their account for 90 days, or does the bank say, hey, it's okay, we trust that the service, the source?
Good question. We're starting to see lenders ask that sometimes. Not necessarily 90 days, but show source of funds. So they want to see the, a recent investment statement or a snapshot of the account in which the gifter is drawing that money from. And I can tell you that the concern with the federal government and OSFI, the banking regulator, is that the parents are borrowing that money to gift. So it's not really a cash gift, it's borrowed money.
Yeah, and I guess can they service it or whatnot, which is a different rabbit hole. But and I guess like I had a client ask me about using his income tax, which is completely fine if it's your own cash, your income tax. You
100%.
just would prove that. Okay.
Right. As long as we can validate where the money is coming from and it's coming from a reasonable source, yeah, no problem at all.
And now, since COVID, have you noticed an increase in gift letters, or is that, would you say so, or?
A massive, yeah. So the numbers on gifts and I think, I don't know if it's a result of COVID, but certainly a result of an increased average home price in Canada. Home ownership, the barrier to entry has just become too high to come up with that down payment. They need help.
Yeah, no, and it makes sense. And just, I think with the COVID thing, I know back when I couldn't take my kids to the playground, right? I could just imagine the grandparents being like, take this money, go buy a house, and there's nothing to buy, right? And hence what we have for the market. But okay, our next question, or the question I had was just, what was your recommendation for who should be looking at a variable option for fixed or variable rate versus a fixed rate? Just wanted to kind of touch on that for our viewers.
Yeah, good question, John. I'll first start out by saying statistics over long periods of time will show that 80 to 85% of the time variable rates outperform fixed rates. A single family income, someone who's going to be kept up at night worrying about their variable interest rate change should 100% of the time be in a fixed rate. There's a cost of insurance. So fixed rates are higher than variable rates. And there's a cost of insurance baked into that, right? So it gives them security. They have to be mindful that if their term is 5 years, and 5 years from now, if the interest rates have gone up, they're going to have to deal with it anyway. But there are certain people that just should be in a fixed rate due to, it's hard to put a price on peace of mind. Variable interest rates, if I'm asked my opinion, if somebody calls me and they want a fixed interest rate, I'm not going to talk them out of it. If somebody calls me and asks my opinion, and my opinion is an informed opinion, I spend my life understanding this stuff. That informed opinion is variable. You're getting paid an extremely high price right now to go variable over fixed. The spread is almost 1.5 points. Okay, so fixed rates have gone up recently. They're going to continue likely to increase a little bit in 2022. Whereas the variable rates are still quite low. And so the difference is about 1.5%. That cost for that insurance for that fixed rate is very high right now.
Yeah, and then when people say interest rates are rising, and we talk about a rise, like they don't go up 1% at a time, correct? It's 0.25%, 0.5%'s a big move, correct?
Yeah. Yeah, 0.25 point is generally what the Bank of Canada or fixed rates operate a little differently. I can get into that actually. But yeah, 0.25 point is generally what the Bank of Canada is going to do. They meet and review this stuff and policy 8 times per year. That's put on the Bank of Canada's website every January. So, and maybe just touch on something here, John. There's a significant difference between how fixed rates are dictated or how they're priced and how variable rates are priced. So fixed interest rates are dictated by bond yields. Bonds are fickle. They're much like stocks. You've got institutional investors, individual investors, governments that are either buying and selling bonds and creating a price war. It's a bidding system. So that bond market has priced in and speculated that we're going to see 5 to 6, maybe 7 increases on the prime rate of lending in 2022 to 2023. Is it actually going to happen? You know, when will it happen and by how much? So will the variable rate move up that much? The reality is, if the prime rate were to move up 1% very quickly, we've got a debt load in this country that will likely create recessionary pressure. And in recession, interest rates fall right back down. So fixed rates right now are baking in a lot of price increases that are not likely to happen as quickly as it's, speculating.
Yeah, that makes sense. Thank you.
You're welcome.
Yeah, and that kind of answers what my next question was, we hear a lot from home buyers and just people talking about the market that interest rates are going up in 2022. It's gonna cool the market off, and everything's gonna be back to normal next year. What are just an opinion, or your again very informed opinion on that topic of discussion, I guess?
So, Dana, just to be clear, like where I think interest rates will go in 2022, without question, they are going up. Difficult answer to articulate in full, but we have to remember at the onset of the pandemic, we saw about 100 to 125 basis points in rate drops. The only reason we're hearing right now about pricing and starting to see some price increases is because, again, that speculative bond market that's pricing fixed interest rates is seeing an inflation number that we haven't seen in 18 years. So is that inflation transitory? Is it due to the supply? Is it due to the pandemic? And will it normalize? The Bank of Canada is on record saying that as the world normalizes, they're not going to have to increase that prime rate of lending. So to be clear, the Bank of Canada is forced to increase interest rates to slow inflation down if it doesn't fix itself. They've got a target they want to be at, which is 2 to 2.5%. And if it gets well beyond that, we're sitting around 3.9 or 4%, I think, right now in the CPI. If it doesn't tame itself down, they have to take measures to cool it down. They claim that it should not be much of an increase on the rate to cool the inflation story. So then the further increase, interest rate increase talks from there just become debt load in Canada, Canadian dollar, GDP, all of the other things, economic indicators that influence prime, and all of those things are weak right now, which will tell us that the interest rate should stay low. Are we going to see increases? Yes, just not to the level. I don't believe, I don't have a crystal ball in this stuff, or at least it's quite murky. I don't believe we have a tremendous amount of concern ahead of us.
Perfect. Thank you very much. Nav, you had another question for Chad?
Yes, I do. So, Chad, I know that lenders run a credit check when they first pre-approve you. Do they also run a credit check once you submit the application? And also, let's say if the possession is 3 to 4 months after you have signed everything with the lender, or they have given you pre-approval, do they also run a credit check right before they advance funds?
Good question, Nav. And I'll just maybe take this moment to really differentiate a pre-qualification and a pre-approval. So if you are sitting with a mortgage professional and they're telling you what your qualifying limits are, and they have not pulled your credit, I would be reluctant to use that pre-approval number to shop. It's just simply math and nothing more. So yes, a credit check is required. that credit bureau is going to, with most lenders, expire in 30 days. So if you receive an offer for your client and within 30 days, I can use that same credit bureau. If it's outside of 30 days, I've got to get an updated one. If possession is 6 months away, or on new builds, sometimes 1 year away, and why it is so important to have a conversation with clients about how to manage their finances in that timeline between, you know, offer and possession. The lenders reserve the right to do a credit check. Do they do it always? No, but they reserve the right to do it. So you can assume yes.
Okay, no, that's good to know, because I've had a lender who was asking for, I mean, even employment letters. A lot of lenders are asking for employment letters right before they advance funds, even after they have given pre-approvals. And it was just surprising to me that they're doing that after approval has been issued and before they're advancing funds.
So now a lot of times we do as much as we can. A good mortgage professional knows what they're doing. They'll ask for an employment letter. They'll ask for some T4 income history. They'll ask for the proper documents to give them the confidence to go out and shop. But sometimes that process can take 3 or 4 months before they find that home, or this year I've seen even longer. The letters of employment generally are worded, particularly with government, they won't validate the details of that letter outside of 30 days. So if the lender's fear is that if they call to confirm that letter of employment under, if it hits audit, that they just won't give them the information they've asked for. So they oftentimes ask for an updated letter of employment within 30 days.
All right.
But thank you, that's good to know.
Yeah, very interesting too, because I find from a realtor perspective, from, you know, every employer for some reason has an issue giving an employment letter. I have never experienced this, you know, an easy process for some reason with employers, which I understand. And so I guess from both, you know, from both the employer's perspective and the lender's perspective, you know, things, who knows, until shortly before the house closes. Yes, this person has a job. Yes, you know, we're good to go.
There's ways around employment letters. Not all lenders require them, but it may require the client's patience in collecting a lot more documentation otherwise, and limiting their options down to the lenders that don't require employment letters. So I think setting the expectation with a customer up front, at least in my point of view, when I'm doing a pre-approval, is really just to let me help you. And if you take my advice and you set the expectations with them, that process of offering and getting an accepted offer and getting financing done is very smooth. But yeah, I think a lot of times people misunderstand the pre-approval process, particularly when we pre-approved them maybe 9 months ago, and we need to get updates.
Mm-hmm. Yeah, I think you're right. And I think it's a lot about communication and communicating the limits, or, you know, what exactly you're doing. Because you're right, the pre-qualification is essentially going online and like typing in your income into those mortgage calculators and being like, oh, I'm qualified for 300,000 with no other information kind of taken into account. So
we are, you know, your lives, my life is about to get a lot easier in the coming years. There's technology being built in. Equifax Canada, TransUnion, our major credit bureaus have a lot of information on us. There's technology being built to combat fraud, really, and to validate income, you know, through automated sources. So I think that process, that manual job letter and pain in the butt conversation with the client, that's going to just get easier over time.
that's good to hear. John, you had another question for Chad as well.
Yes. So my understanding, people look at the best rate, right? Now, there are some more to it, like, you know, choosing a mortgage. There's more than just having the best rate, I believe. Maybe it's regarding break penalties, if you wanted to sell, if you wanted to transfer, whatever. I just wanted you kind of touch on that. You hear from your expertise on what else a buyer should be looking at when choosing a mortgage.
Yeah, really good question. Interest rate's an important part of the mortgage, a very important part of the mortgage, but it's certainly not everything on the mortgage. They need to consider, well, I mean, all of the points that you mentioned are top of mind. Term length, the penalty, the discharge fee, is the mortgage portable? Can you add a home equity line of credit? These are all things they should be asking and working with their mortgage professional on to understand what future needs might look like, and to plan for life events that, you know, they happen. So a lot of variable interest rates, for example, it's just a common knowledge that they have a 3-month interest penalty. But I can tell you with certainty that if the client that is just honed in on interest rate, that goes out and finds the best variable rate that they possibly can by making a million phone calls or looking online, they're going to end up in a restricted variable rate mortgage that bears a 3% of balance penalty. 3% interest, 3% of balance, two very different numbers, but it gets missed. So these are questions they definitely should be asking. Do they see a move in their future? You know, can they port that mortgage with them? And if so, where can they port it to? What are the terms?
Yeah, thank you. See, there's lots that you know, we maybe think of but don't know the details, and that's something where it's nice to have someone like yourself to kind of help guide that person as well.
Yeah, that's an interesting point too, because I honestly, maybe just my own you know, experience, but I didn't know that some mortgages are not portable. So learning things as we go.
It's important for consumers to understand that the mortgage market has gotten extremely competitive. So it's a race to the bottom for these lenders. It's like, who's willing to accept the least amount of profit? And there's really only so much money on the table. They all get their money from the same places. So, you know, are they efficiently run? And it gets to a point where they need to claw back features from that mortgage to get it just that little bit lower and be able to sell it.
Yeah.
Ultimately, that can cost the client dearly in the end.
Absolutely. Yeah. And they're, you know, you're right in the sense that the research that goes into it, it's very interest rate heavy, not as much detail oriented for most people. Oh, go ahead.
Just to add on to that, you know, I recently have had this conversation with a client where they weren't able to refinance their mortgage with a lender. And, you know, at that time, I guess you don't think about those things. But now with everybody refinancing and trying to get a lower rate, they're locked in a mortgage where they can't really do anything. And also, I know a situation where, you know, let's say you have a family breakdown and the lenders, well, this lender particularly was, you can't remove people from titles. They don't let you pre-qualify as your own. So it also becomes an issue when the lenders just were like, no, you're locked in. There's nothing more we can do. You can't refinance. You can't move your mortgage. You can't discharge it. And it's just very, 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 they're very strict with those things. I mean, I guess lesson learned even for those clients, other than the rate, there's a lot of other things that you need to look at when you're looking for a mortgage, especially if you know if you're going to change a house in 4 years, which is under the 5-year term, you know, and other things. But while, let's say if your interest rates are high right now and interest rates are expected to drop and you're looking to refinance, you need to be able to refinance your mortgage. Otherwise, you're locked in a mortgage for 5 years at least.
Mm-hmm.
Circling back on John's question, that ties in really nicely, but you know, one of the most daunting restrictions that you see in a mortgage, and it's in there out there a fair bit, is you can't break the mortgage to refinance. You cannot get out of the mortgage without a bona fide sale agreement. So there's no ability to do anything with that mortgage. you know, I can definitely tell you that in our office, we steer far and clear of those, even if the interest rate is better, because the inevitable will happen. And of course, we look like the bad guy 3 years down the road, and we don't want to put a client in that position.
Yeah, interesting. Kind of along similar lines, but coming from a mortgage broker's perspective, can brokers help clients with home line of credits, you know, kind of more flexible programs down the road? I guess maybe it depends on the lender, but can you just talk a little bit about that?
Yeah. So as brokers, we have access to a variety of different products. And if we're doing a good job with a client, we need to sit down and understand what their needs are and what their current future might look like in terms of mortgage planning. So again, getting away from the interest rate, let's sit down and have a real conversation of what your life looks like for the next 5 years in a mortgage. Do you see a move? Do you need to renovate? All of these things. Now, when setting that mortgage up, not all mortgage companies have a line of credit product. But if we see a need for that line of credit coming down the road, or if they've got an excessive amount of equity that's currently in the house, those are good conversations to have, so you're prepared when the time comes. We can absolutely, I've always looked at my practice as a financial planning firm. I'm not paid that way, but call it a mortgage planning firm. You know, financial planners are paid a residual income over time, right? We're paid once, much like a real estate agent. But I don't look at my practice that way. I'm here for a client and I want to take care of any needs they have midterm. And being in the right product and allowing us to be nimble is allowing us to do our job better.
Yeah. Yeah, and kind of, I guess, full circle, you know, even though a lot of these things that we just touched on are maybe something that you don't foresee coming up, like, you know, family, you know, taking somebody off title or whatever.
Yeah.
But flexibility in a mortgage is important because we don't know what 4 or 5 years from now is going to look like. So that should be a high topic of conversation.
A large misconception in the market, I find amongst consumers, is that I already have the mortgage. I just want to take somebody's name off of it because I don't need the cosigner anymore, or I, you know, went through a marriage breakdown or whatever the case might be. But the reality is you need to qualify for that mortgage with the way that you want it set up at today's date. So, you know, if you want to remove mom and dad because they've co-signed on your home, but you still don't have a job, it's not going to work. So we need to re-underwrite the mortgage and make sure it fits the guidelines.
Makes sense.
Yeah.
Awesome. Do we have any other questions for Chad before we let him go?
No, I don't, but yeah, no, thank you very much, Chad, for answering these questions. I think a lot of people would find a lot of value in some of these off topics nobody discusses.
Absolutely. I totally agree. Awesome. Thank you so much for watching, and we will see you next month.
Thanks for the